Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. After a 13-year career at CSFB, where she would ultimately head the firm's equity derivatives strategy effort, in 2023, Mandy Xu moved to the Cboe, where she's now head of derivatives market intelligence and swimming in interesting, complex data sets. Our conversation surveys product innovation, going back to the first option trade ever on the Cboe, call options on July 1973 Xerox, through today's vastly electronified ecosystem of trading in cross-asset risk exposures. We briefly review the unbelievable short squeeze in GME from 2021, and here Mandy asserts that today's exposures are considerably more balanced than the meme episode in which the retail stampede engorged on call option premium. Our discussion moves to the present-day backdrop for option pricing and the potential impact of mechanical flows resulting from vol being bought and sold in the market. Noting the substantial increase in AUM for overriding and option income-generating funds in both the mutual fund and ETF complex, Mandy is skeptical that this growth is solely responsible for the low clearing price of measures like the VIX and put skew. Instead, she points to low risk readings in other asset classes, including credit implied vol, as more likely driven by stable macro fundamentals. We spend the remainder of the conversation on the much debated topic of zero DTE and whether there's an accident waiting to happen. In Mandy's role at the Cboe, she sees option flow with great granularity, and in the ultra short dated category, she sees considerable balance in use cases across hedgers, income generators, and intraday traders. The result is a healthy mix of buyers and sellers, and, at least for now, a low risk of Volmageddon 2.0. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Mandy Xu. My guest today on the Alpha Exchange is Mandy Xu. She is the head of derivatives market intelligence at the Cboe. Mandy, it's great to reconnect, and it's a pleasure to have you as a guest on the podcast today.
Thanks, Dean. Yeah, it's definitely my pleasure to be here today.
Well, I just love your title, head of derivatives market intelligence. And as someone who's been in the derivatives side of things for quite some time now, I think that there is a lot of intelligence to be derived from evaluating this just broad array of market prices that the derivatives markets provide us as food for thought. So we'll have a lot to chat about in your role. Let's get our conversation going and just briefly tell us a little bit about your career history. Obviously, you spent a lot of time at CSFB before moving to the Cboe, but just give us a little bit of flavor for your background, how you got started in the industry, and then we'll talk about your role at the Cboe.
Yeah, sure. So I joined Cboe last summer after a 13-year career at Credit Suisse, where I started out as a first-year analyst on the derivatives desk post-global financial crisis. I've always been on the equity derivatives desk as a strategist, and my role kind of evolved from being a first-year analyst, running a lot of the analysis, to running the group and really carving a niche for myself in terms of becoming an expert in terms of index volatility, ETF, and macro volatility. So that's a lot of what I did at Credit Suisse, running market commentary for the desk and coming up with trade ideas for the major institutional clients of the bank. And then early last year, I was kind of looking for a career change, and Cboe was actually a really smooth and easy and almost obvious in hindsight next step for me, in the sense that it allowed me to build on a lot of the experience, expertise that I had already garnered on the sell side in terms of derivatives experience. And obviously Cboe being the exchange for all SPX and VIX options was like the perfect kind of next step for an equity derivative strategist. But in my current role, and what actually really exciting is not only just getting to do a lot of what I used to do, which is market commentary and analysis, but also playing a role in helping develop new products, bringing new products to the exchange, to the market, speaking to clients about what are some of the gaps in their portfolio and how, Cboe can play a role in filling that gap. So that's been really exciting. And, as I said, I've been in this role for almost a year now, and it's been going great.
We're going to talk a lot about the product side of things. And of course, the Cboe last year celebrated its 50th anniversary. So the first listed options were traded in 1973. And along the way, there's been lots and lots of financial innovation, and the VIX is a centerpiece of that. During your time at CSFB, there was the TVIX, which for a period of time got really dislocated from its net asset value. Then, of course, we had some pretty spectacular blowups of ETNs that were based in some way, shape, or form on the VIX. Just give us a little bit of perspective as you think back on your career at CSFB and the development of some of these products that are centered around the VIX. I'd love to just hear you talk out loud as you sort of think back on these low vol events or low vol periods, these spectacular right tail events on vol. What's on your mind with respect to the VIX and just the history of the VIX?
Yeah, sure. I mean, it's a great point. You brought up the 50-year anniversary of listed options last year, Cboe. And actually, this past week, coincidentally, was the 20th anniversary of VIX futures being launched, right? So that was exactly 20 years ago. So I think the space has certainly come a very long way. And I think what's great about the VIX and what's great about a lot of the products we launched around the VIX is it has made volatility very accessible to a lot of investors. I think 20 years ago, for someone to trade volatility, it was a much more complex trade. It was maybe not so accessible. Whereas now, you want to take a view on where the VIX is going to go. There's VIX futures, there's VIX options. Obviously, you can still trade SPX options to also, get a view around VIX. And along the way, in these 20 years, you pointed out a lot of product innovations that have happened on the back of the volume that we've seen in VIX futures and VIX options. And here, kind of where I sit, I'm really excited to kind of see where the next stage of this iteration goes. What other products or what other risks can we make more accessible and transparent for investors to take a view on, to be able to trade? And I know we'll get into it a little bit maybe later in the call, but dispersion to me is kind of the natural next step, where almost parallel to the VIX in the sense that, VIX index made volatility the benchmark for a lot of investors. People want to know every day, what did the SPX do? What did VIX do? Our goal, hopefully, with dispersion and our DSPX index is to make that also a center point in a lot of conversations to really help understand what's going on in the market, not just at the index level, but also underneath the index surface with single stock. So that's kind of the next iteration. But here at Cboe, we have a whole labs team that is dedicated to product innovation, speaking to customers to figure out what are, like I mentioned, gaps in the portfolio. What are some risks that maybe they're trading over the counter that's become illiquid that we could bring to the listed exchange and make it more liquid, make it more transparent, and really increase the pool of investors who are interested and active in that space.
Yeah, you mentioned the Cboe's work on dispersion indices, and definitely something I want to cover in this conversation. We live in this time of just extraordinary low realized correlation, and of course, implied correlation as well. So that's definitely something I want to circle back to. I wanted to just read something that is from a New York Times article from April 26th of 1973. Okay, so this was the announcement of the idea of trading listed options. So they were just call options. And the article says, trading in 16 issues began this morning. AT&T, Xerox, Kodak, McDonald's, and a dozen others. Trading does not involve dealings in actual securities, but rather in the rights to buy them in blocks of 100 shares. And then it says the first trade to cross the Cboe tape was an option for July Xerox. And so it goes through some of the actual prices that cleared. So I looked at it on a backward basis and I calculated that it was about 32 vol, the first trade. So anyway, quite a ways ago. And of course, over those ensuing 50 years, I mean, volumes have grown, products have been created. The exchange is so vastly electronified. We now deal in these kind of micro expirations, which is just a fascinating development and something that we're going to cover. I would love for you to just tell us a little bit more about this transition from CS to Cboe, because the role of a derivative strategist at a large bank is to be thoughtful on ideas, field requests from clients, engage clients on trade construction. You're meeting with hedge funds and insurance companies and the like. I can imagine there's at least some notable differences in your role now, just given that the Cboe is not a big bank, it's an exchange. Tell us a little bit about the transition and how some of the duties are the same and how some are different.
Yeah, sure. And you mentioned it in terms of helping clients come up with trades and portfolio construction. I would say that is a big difference in that being an exchange, obviously we're not an investment advisor. We do not give investment advice. So whereas used to, give a lot of trade ideas, that is something that I'm less focused on in my current role. So that's one big difference. But I would say some other big differences is that this is something I didn't really fully appreciate until I moved over, is that when you're on the sell side, right, your clients are the buy side institutional investors, whether they be hedge funds, pensions, asset managers, insurance, or in the case of CS, our very large private bank clients. And that's great. That's a very broad ecosystem of buy side investors. But when you move over to the exchange, you realize that's still only one part of the ecosystem, right? The exchange really touches everyone. So in my current role, I talk not only to the same buy side clients that I used to talk to when I was at Credit Suisse, but I talked to the rest of the sell side banks. I talked to the market makers. I talked to retail customers and retail brokerage firms. I talked to our index providers, right? So S&P, FTSE Russell, MSCI. You really, I think, get an appreciation for just how big the ecosystem really is and the different investor types and the different parts of the ecosystem. So that I would say has been really the biggest change and the most pleasant surprise to me, because in some ways I knew that, but really it was kind of moving to the Cboe, and especially I think coming at this particular in time with the rise of, I think you alluded to, the 0-day options, right? Trading, and a lot of it being electronic, and the increase in retail participation in the options market that we've seen, particularly in index options over the past 2 years. It's really come at kind of the right time, or the perfect time for me, at least.
And you mentioned technology. I was on a long flight a couple of days ago, and one of the movie choices was Dumb Money. So it's the GME story. And I think the movie was actually reasonably well done. And what a fantastic learning experience just around the behavior of markets, on crowding, and I think a lesson on just the dangers of volatility from the short side. I mean, vol can be dangerous owning it too, at the wrong price, at least. Reflect on that period. I assume you were still at Credit Suisse during the meme stock episode, right? Jan 2021.
Yeah, I think the pain for a lot of the investors I spoke to was really concentrated on the hedge fund side, particularly the equity long short hedge funds that were maybe on the other side of a lot of the, let's say, retail squeezes that we saw in those names. But it's interesting because we saw some very extreme dislocations in the volatility market back then at the single stock level, right? And it was obviously most concentrated in the super small cap stocks like GameStop, AMC, et cetera. Hertz, I remember, was another big name. But really, it spilled over that euphoria, the thinking that the stocks only go up, right? That spilled over into the options market for a wide swath of stocks. So one metric that I used to track was what percent of the stocks in the S&P top 100 had inverted skew or inverted call skew, where your out of the money call options were trading at a premium to the at the money, which again is historically very atypical. You may see it sometimes for certain names going to earnings or in advance of a catalyst like a biotech name ahead of an FDA announcement. But generally speaking, it's very atypical. I think the 10-year average prior to that period was like 6% of stocks at any given time in the S&P top 100 had that characteristic. In 2021, that percentage hit 50%. So that was a pretty incredible period in the derivatives market. But if I want to tie it back to what we're seeing in the market right now, because every time I talk about retail adoption or retail usage of options, of index options, a lot of people automatically, I think, assume that this is just an extension of that same kind of meme stock FOMO era that we saw back in 2021. That's just migrated from single stocks now to index options with the 0 DTE. But really, it could not be more different, right? And you can see it, for example, in the put call ratio. Back then, the put call ratio got extremely distorted for single stocks. It was like, I think, 2.5, 3 times the number of calls traded for every put. It got to the most dislocated or most extreme level since the tech bubble, so like a 20-year extreme. If you look at SPX 0-day option, zero put call ratio, it's been pretty balanced at 1-to-1 this entire time for the past 2 years during the rise of 0 DTE trading. So that is something that I want to emphasize, that at least the retail activity that we see on the index option side with 0 DTE is very different from kind of that FOMO driven frothy market that we saw in 2021, at least for options. in terms of the volume that we see, in terms of the impact on the vol surface that we see.
It's just such a fascinating period that was. And so now things are, I would say, more normal than not. But I'd love for you to frame out what you see just in the broad landscape of prices, option-centric prices, whether it's across asset. You did mention term structure, perhaps skew. Give us the broad mosaic that you're looking at, and then we can kind of drill down into some of the specifics.
Sure. I mean, in terms of themes in equity vol and really volatility in general, I mean, what's on everyone's mind is just how low it is, right? That's been consistently the number one inbound question I've gotten over the past couple of months is why is the VIX so low? Is it low because potentially being distorted by other factors? I think a lot of people have cited the growth in option income funds as a potential driver. Personally, I'm not so convinced, and I'm happy to dig into why that is. But I would say low vol as a theme has been very prominent in a lot of people's mind. And it's been very surprising because I think coming into the year last year, everyone thought or expected volatility to remain elevated in a similar range that we saw in 2022, let's say in the low to mid 20s was kind of the consensus expectation. And then instead we got, VIX in the mid teens. And this year to start the year, I think VIX in the low teens, right? So that's been very surprising. Underlying that has been the continued flatness and skew. So in layman's term, just the lack of demand for protection that we're seeing in SPX and index options in general. This has been a trend gone on for almost 2 years at this point. Different drivers, I would say, that this past year versus what we saw in 2022, but certainly the low levels of index skew has been very prominent for a lot of people. A lot of questions around when, if ever, it will normalize. I mean, it will normalize at some point, but what are some of the catalysts that could potentially drive a normalization in skew? And then the other one which we touched upon already, which is dispersion and correlation and how extreme both have gotten over the past years. So people talk about low VIX and low index vol, but correlation is even more extreme, right? Like S&P implied correlation, at least for longer dated tenors, is lower today than it was in 2017 when VIX was at 9. So we talk about why that is, the continued high sector rotation that we continue to see, stock selection being very important in this market. But those, I would say, some of the broad themes that's been very top of mind for a lot of investors.
And you've also talked about depressed levels of other asset class vols. I think you've mentioned FX, and maybe rates is a little bit different, but even that one's coming down as well.
Right. So that's mostly to make the point, again, like when something unexpected or surprising happens in the market, I think people's first instinct, or oftentimes people start blaming it on technical factors, right? I remember it used to be market sells off because of risk parity rebalancing, market sells off because of vol control funds rebalancing, or CTA momentum funds. Last year, anytime the market sold off with zero DTE, options driving it. And recently it's been VIX is low because of option income funds. And the point about low vol across asset classes is really to say that, in my view, the main driver of low volatility has to be macro fundamental because of the fact that we see it across all asset classes, right? So yes, rates vol is still relatively elevated. We can talk about why that is, but even there, it's come in significantly over the past year. Rates vol currently is around the lowest of this hiking cycle, this recent cycle. And then every other asset class, FX vol, credit vol, commodity volatility are all below average. Credit vol, in fact, if you look at VIX IG, which tracks the implied volatility of CDX investment grade index, that's at a 10-year low currently. So to me, it's really a reflection of the fact that the macroeconomic outlook has changed so materially, has changed so drastically over the past year. We've gone from everyone expecting a recession, talking about how there's no way the Fed could land the plane, could really bring down inflation without causing a recession, to now soft landing is a consensus. And we're talking about even potentially no landing, like the economy just picks right back up. So I think that, to me, is the number one driver, the main driver of low volatility. And of course, you can then layer in additional reasons why equity volatility is so low. We talk about skew and correlation and things like that, but those are just marginal, I think, drivers of a low volatility. At the core, I think, is really a reflection of the improvement in the macro outlook.
One of the things I personally think the Cboe does quite well is develop these indices, and whether they're tradable or not, like the VIX has become incredibly tradable, they are a source of rich information around trading strategies, around the price of risk, around the different alternatives in terms of what you're trying to accomplish. I've seen put hedging indices. You've got an iron condor index, the VVIX, right? The vol of vol. So you referenced the VIX HY, and then there's the VIX IG. It'd be great if you could just maybe frame out the concept behind, let's just say VIX HY. I just looked at it, and at least on a recent basis, it's actually even lower relative to the VIX than it normally is. And so it's just interesting, as you say, that credit vol is super low as well. So what are you measuring there in VIX HY?
Yeah, sure. So VIX IG and VIX HY are two indices we launched last year, and it's actually two of a broader suite of credit vol indices. So there's also the equivalent for the European credit, but VIX IG essentially measures 1 month implied volatility for the CDX investment grade index, and VIX high yield measures the 1 month implied volatility for the CDX high yield index. And it's using the same methodology as the VIX index, which everyone kind of is familiar with or knows and trusts, and we're bringing it to the credit market, and we're working closely with S&P Dow Jones, which owns iTraxx or Market, that aggregates all of the CDX prices from the various different dealers. So we take an end of the day snapshot of the traded prices across a wide range of strikes for the various credit index options. And using the same methodology as the VIX, we derive a number that's really meant to give you expectation, a forward-looking expectation of how much the underlying index is expected to move. So a couple of kind of basic things to know is that the indices are quoted in bips vol, so normal vol. So if you look at, for example, VIX HY right now, I'm pulling it up on my screens, it's currently around 118. So that's basically an expectation that the underlying index, CDX high yield, is going to move 118 basis points up or down in annualized terms in the next 30 days. So that's very similar to how VIX measures how much of the S&P is expected to move on an annualized basis for the next 30 days. It's the same methodology that can apply to the credit space. And to your point, yes, credit volatility is extremely low. And I think, again, I bring it to the point that the change in the economic outlook and how consensus soft landing has become, you really see it in the credit market in terms of VIX IG and VIX high yield being at, in the case of IG, at a 10-year low, and in the case of VIX high yield, it's at a multi-year low.
So just running with this concept of data and indices created around complex data, and the window that you now have to look at these types of innovations in creating these indices, share with us anything else that you've seen that has been especially interesting to you in your new role with respect to data sets that the Cboe is generating.
Oh, sure. So I did not appreciate until I really moved to the Cboe just how much data as an exchange you really have. And I think it's becoming more and more in demand or sought after by customers, by clients, because of the rise in electronic trading, the rise in zero-day trading, where a lot of the volume is not going through high-touch desks, but rather through the pipes, and therefore third-party observers have very little visibility into the flow. So to really, truly understand zero-DTE flow, you have to basically use our data sets, right? So our data sets, the open closed data set, which has been by far the most popular one over the past 2 years, looks at all the volume on our C1 exchange, which is the exchange where all SPX and all VIX options are traded. So there's been a lot of interest from customers in terms of purchasing the data set, looking at the data set and devising trading strategies, or just to getting better understanding of zero DTE trends and zero DTE flow, because of the fact that it's now 40 to 50% of all SPX option volume, and the fact that, again, outside observers have very little visibility in that. So in every client meeting that I've been to in the past year or 8 months, that's been a topic that people bring up over and over again, is just the appetite for data, and more data, better data, more frequent data, in order to better devise strategies and then to better understand what's going on in the market.
Well, we'll talk a lot about zero DTE, and maybe as a preview to that, we can talk about VIX 1 day, the VIX 1D. I think it's an interesting index. I've certainly gotten some value out of it and noted just how much premium there was in the 1 day VIX ahead of 3 big data releases, especially in 2022. It was NFP, CPI, and FOMC days. There was just a huge premium going into those days on 1 day vol as reflected in the VIX. And you'd get your move. It was almost like an earnings day. You'd get your move, and then the index premium would get sucked out of it because the move was over. So the market kind of had to learn its lesson on overpaying for these ultra short dated options as the Fed cycle matured. And there was just less oomph, I suppose I should say, in terms of the market's move in response to the data.
Yeah, no, that's a trend. If you look at 2022 versus 2023, certainly I would say the event risk premium in 2022 was a lot larger than it was in 2023, right? And in terms of those subsequent realized moves, that gap, there's just a lot more of that premium to be harvested in 2022 when there was just a lot more uncertainty around inflation and just exactly how high it was going to go. Whereas last year, by and large, the narrative had shifted to inflation that's falling. The question is just how quickly. So I think that kind of helps to explain some of that difference in the event risk premium. But bringing it back to VIX one-day index, yeah, I think you're absolutely right. There's definitely value to be had from the index. I think a lot of people look at the intraday action of the index and say, well, it doesn't make sense that it would continually go up during the day. And that's really because of the fact that we were trying to give a constant, if you will, 24-hour measure of volatility. So as the day goes on, it starts to use both options that expire the same day as well as the next day, and then kind of interpolating between the two to give you that constant 24-hour measure of volatility. So that kind of explains some of the intraday quirks. But the way that I use it most often is if you look at the opening print of VIX one day, that is entirely comprised of options that expire that same day, right? So that's a really good way to kind of get a sense of how much implied volatility is in the 0-day options. And you can obviously then compare it to the subsequent realized moves and try to figure out that 0 DTE, vol risk premium that is currently in the market.
Well, I mentioned the first trades ever in call options from 1973 on Xerox. And back then it would be pretty hard to argue that the overlay of things like gamma and vega exposure in the market was impacting the market. But today, it's probably a different story, and it gets a lot of debate. There's, of course, very good logic for trying to understand mechanical flows, whether they're hedging flows that are forced by the existence of gamma profiles in the market or mark-to-market risk, those sorts of things. You get a lot of attention, as they should. They can be also very difficult to truly pinpoint. But look, you've been at this a long time. You've seen these super low vol periods. You experienced the XIV blow up, of course, as a strategist. So maybe as we get this part of the conversation on 0 DTE underway, tell us just about your framework for thinking about the existence of trades in the market. How much attention do we have to pay to the flows and the hedging behavior? Frame that out for us.
Yeah, sure. I mean, you bring up a good point that like the interesting gamma profile and vega profile, all of that. I think before coming to Cboe, at least on the sell side, I was always a little skeptical of any kind of analysis around that, only because, again, what determines true gamma positioning or the risk, you really have to get a good sense of the actual breakdown of the flow, right? And a lot of times when people talk about sell side, like dealers are short or long X amount of gamma, it's based on estimates because all the data that we see, right? The open interest data, and you don't really know, or the volume data, but you don't know how much of it is buy versus sell. So I was always a little skeptical, to be honest, of any kind of those gamma analysis around option expirations. Not to say that it can't be impactful, it's just that it's hard to know because at any given sell side bank, we only see part of the flow. So I remember, I used to run this analysis looking at the flows that the Credit Suisse would see and then say, if we extrapolate that for the broader market, this is kind of maybe what we would estimate. Other people, I've seen take very extreme estimates, and I think wildly unrealistic, where they assume 100% of the puts are bought, 100% of the calls are sold, and therefore you get these large gamma numbers that obviously make headlines, but clearly not reflective of the flows that we see in the market. Now, the difference, I would say, coming to the Cboe, as I mentioned, is now actually at the Cboe, I do see the positioning, right? Because all SPX options trade through the Cboe. So I can see for every trade whether something is opening, closing, buy versus sell, whether it's market maker or customer. And this is part of that open close data set that I mentioned that is being so highly sought after, because once you have that data, you can really actually build a pretty accurate sense of the positioning in the broader SPX market, but particularly in 0 day, which is, I think, what a lot of the focus around gamma positioning is centered around. It's the ultra short dated space. So once you have a clear understanding of the positioning, it's not making assumptions. Like I assume this contract was bought. I assume this was sold. I can actually see whether it's bought or sold and by who. So then you can actually build, I think, a realistic, accurate picture of the gamma positioning. And that's what I think it's useful. It's when the gamma positioning is based on a lot of assumptions and estimates, when you don't see the flow or you don't see the entirety of the flow, then you can really start to question it. But for SPX, and at least at Cboe, because all SPX options, again, trade on Cboe, we see 100% of the flow. We don't need to make assumptions about what a portion of the flow looks like because we see it all. That's where the value of talking to the exchange and the value of being at the exchange really comes in, is the information that you can provide to customers.
Well, give us a mapping of those flows. You've got speculators taking a shot who look at one-day options and say, gosh, that premium's real low, perhaps not appreciating the severity of the time decay that they'll undergo. You've got the income funds, which I definitely want to talk about, this proliferation of mutual funds selling call options. Sometimes they're selling put options, and sometimes they're extremely, extremely short dated. There's been a lot of growth there. You might have hedgers. And then, of course, you've got the vol community at large who's responsible for making prices and risk managing these exposures. How should we think about the landscape of participants in the short dated market?
Yeah, sure. I think you've given us a really good preview. So what stands out to me is that it's really a balanced mix of all of the various use cases you mentioned and also investors. So we see a pretty good mix of both retail and institutional. And in terms of use cases, why people are trading it, a lot of people do it for hedging purposes, whether it's intraday hedging, then risk hedging, overnight risk hedging. We see people use it for income. That's been very popular. And a lot of people looking at using these options for intraday momentum and reversal, right? A really easy way to play intraday moves with incredible leverage in the market. So when you break it all down, what we see is about half of the flow is in complex orders. And that's largely, again, people selling the spreads for income. So selling put spreads, call spreads, iron condors, various iterations of those. So that's like a big part of the market. And then the other half is in single leg orders that I would say are mostly for directional leverage or for hedging, or sometimes the single leg orders, I would say, is tied to the complex in the sense that people who sell these complex spreads often will position manage that spread throughout the day as the market moves. So a lot of the single leg orders, I would say, is also tied to the complex order volume. But what we see is a pretty good mix of all the different various use cases. I already mentioned in terms of put call ratio, it's extremely balanced at 1-to-1 and has been that way this entire time. And that's very unusual for index options, right? If you look at non-zero day option flow, it's much more tilted towards puts because primarily people typically historically use index options for hedging purposes. So for non-zero DTE flow, it's, I would say, much more tilted towards hedging. But for zero DTE flow, it's very much balanced between puts versus calls, and it's very balanced across strikes between buys versus sells. And this is really, I think, the crux of it, because a lot of times when people talk about the risk with zero DTE trading, the gamma risk, the market impact risk, they focus on the notional volume. And the point that I've been trying to hammer home for the past year is that high volume doesn't equal high risk. Just because 100,000 contracts trade on a particular line doesn't mean that market makers are on the other side of that 100,000 and have to buy or sell. If, for example, that 100,000 contracts is 50K customers buying, 50K customers selling, then actually there's nothing at the end of the day for market makers to hedge on the other side of the flow because it's perfectly balanced. So really what matters for market impact is a breakdown of that flow between buys versus sells. And that's something that Cboe, we can see, we can observe. And when we run the analysis, we find it on average. Again, it's extremely balanced throughout the day on average. We're talking about gamma imbalances, like hundreds of millions, which in the context of overall S&P liquidity and the S&P E-mini futures liquidity, we're talking about like 0.1% of the ADV, right? So in terms of the net risk, it's de minimis because of how balanced it is. Now, could that change going forward? Perhaps, but so far, at least, we track this constantly. It hasn't really shown signs of changing in terms of the trading profile.
Yeah, it's a really interesting point you make. One is the idea behind volume not necessarily being the same as risk. If you had a put option just traded back and forth ferociously and then just closed out, it's almost like day trading. But you also point to the reality that there is just a lot of leverage in being able to control so much notional that could exist should the delta go your way with such a low amount of premium. It's really interesting. I mean, look, a lot of this debate goes back to the sort of idea that Volmageddon 2.0 was coming, or at least was a potential based on the take up of this very short dated option. And I suppose the argument put forth was these options were being sold. And so typically a vol event is on the horizon in people's minds when the vol community is short vol. And here the argument was the vol community is long vol, and it's the seller, the opening kind of unhedged outright seller that's got the potential to blow up.
Yeah, so here maybe I'll throw out a couple of stats in terms of the trading volume and also kind of the characteristics that we see, right? So when we look at customer opening trades in terms of who's selling these spreads or who's selling options, very little of it is actually in naked short puts or short calls. The vast majority, over 90%, I think 95% last stat that I saw of it was in capped format, meaning customers who are selling options were doing it, as I mentioned before, primarily through spreads, call spreads, put spreads, right? So your risk is capped so that even if we got a very large intraday move, it would move past your spread and you would be out the width of the spread, but there's not forced unwinds that happen on the back of it. So that's one thing that I think is worth noting, that 95% of the opening short volume that we see from customers is in capped format. And the second thing is one of the distinguishing or main features of the VIX ETP blow up that what we saw in 2018 was the fact that inherently designed as part of the ETP is the fact that the leverage built up over time as volatility stayed low, right? The AUMs grew just by the fact that volatility continued to be low to the point that it got to be too big for the overall market. Whereas here, the risk really resets at the end of the day. There is that not the same buildup of leverage over time that's contingent upon kind of the market volatility being low. So I think those are kind of two very different scenarios. And never say never, but like at least from what we've seen so far in terms of the flow in 0-day options, it's a very balanced between buys versus sells. The people who do sell options are doing it in cap risk format. And by the feature that cash settled index options, the risk resets at the end of the day, it's 0-day option. You don't get that same buildup of leverage that we saw in 2017 and the lead up to 2018. So to me, I think a lot of the fear mongering around Volmageddon is really overblown, at least in this particular case.
I have to imagine that the price maker on this product is not a big bank. There's just not enough time to price this thing up. It's going to be against some vol algorithm that's pricing it out and basically making the market in electronic fashion. What about the initiator? Is that typically a machine that's doing it kind of on a systematic basis? I mean, I know there are individuals and institutions with a capacity to trade electronically initiated by an individual with the screen. So what's the breakdown of assuming it's screen-based, but an individual sitting there and deciding versus some systematic process that's engaging the market?
Yeah, you're absolutely right in terms of the liquidity providers. It's the market makers, not the sell side bank. So the flow is almost split completely evenly between customers on one side and market makers on the other side. There's very little sell side bank participation in the 0DTE space, at least for SPX. In terms of the customer side, right? So the question we always get is like, who's buying or who's trading these options? Is it retail? Is it institutional? How much of it is algorithmic? That actually is one area that I would have to caveat that we have our estimate, but really it's still an estimate at the end of the day. And the reason being is that while we can see where the trade comes from, and we see about 90% of the customer flow in 0DTE comes from a retail brokerage firm, we would very strongly caveat that as being not reflective of the true breakdown, because we know for a fact a lot of the large retail brokerage firms are also used by very sophisticated institutional investors. For example, the Interactive Brokers, the Fidelities of the world, they are not just pure mom and pop retail shops, right? So what we've done on our end to, I think, maybe get a better sense of the breakdown between institutional versus retail is look at not just whether it comes from a retail brokerage firm, but also the size of the trades, the frequency of trading. If someone's trading more than 10,000 contracts a year or a month, I forget what the exact threshold is, or like 20 contracts per day, that's less likely to be retail and more likely to be institutional if the sizes are large. There are also other markers that we can see on the exchange side to better differentiate between retail versus institutional. So when we run our analysis through the flow, our estimate is about 60% of the flow in 0DTE on the customer side is coming from what we would call an institutional or professional customer. And about 40% of it is what we think is more reflective of true retail mom and pop, that type of end customer. But that said, there is very much a blurring of the line between institutional, professional versus retail, because even for a lot of the retail investors, there are now more and more third-party platforms that are springing up where you can algorithmically trade spreads through the day. Like you can target what spreads you want to trade for how much leverage, how much income, and they would actually execute it for you throughout the day. It's linked to your brokerage platform. So actually, that's like a very interesting trend that I've seen is that even on the retail side, like the rise of third-party algorithms to help retail investors trade 0DTE, that's been fascinating to watch.
I'm talking my own book and yours as well, but I think the capacity to trade electronically in the U.S. equity derivatives market is and has been fantastic. And it should be kind of a model for other asset classes to try to get to that level of transparency, that degree of trading technology. It just makes it so easy, and it's a real blessing for the end user. And maybe that's why there's been this huge growth in derivative-centric mutual funds. You've got a great chart in one of your decks about the twin growth, both on the mutual fund basis for option overriding funds, and then also in the ETF landscape. Tell us a little bit about your work there and what you see.
Yeah, sure. So this has been something that's come up in a lot of client conversations over, let's say, the past 6 months, which has been the incredible growth in option income funds. And for those not familiar, that's primarily ETFs and mutual funds that sell options for yield, for income purposes. And in terms of AUM growth, I think the space went from 20 billion in total in 2019 to now over 130 billion. So grown over 6 times in the past couple of years. And if you focus, especially in the last 2 years, 2 to 3 years, the bulk of that growth has come almost entirely from the ETF space. So this has been a big theme in the derivatives market. These funds are certainly huge. Now, the question is, have they become too huge or too big of a driver such that they're the reason why volatility is low? And to me, I think the couple of reasons why I don't believe so. I already mentioned one, which is the fact that low vol we see across asset classes. It's not just an equity phenomenon. But if you look at these funds, they are not all employing the same strategy. There is a diversity in terms of underliers. Yes, the bulk of it is on the S&P 500, but a lot of these funds over underwrite on NASDAQ, on Russell 2000. And actually, there's been a growth in a lot of these single underlier income funds as well. So people writing on, like, say, NVIDIA or some of the mega cap tech names. There's also a diversity in terms of tenors, right? So ranging all the way from 0-day options out to 1 month, 3 months, 6 months, or even further out. And similarly with strikes, some funds overwrite closer to, say, at the money, while others look at 20 delta, 30 delta options for overwriting or underwriting. So because of that, the impact is likely to be more spread out versus, say, if they were all overwriting 1 month options on the S&P, which is kind of what would really impact the VIX. And then the second thing is, if you really look at the impact on the vol surface, the things that you would expect to see if these overwriting strategies or underwriting strategies have become too big, you actually don't see, and it's been the opposite. So things you would expect to see is, one, the volatility risk premium in the market to really just start to shrink. So that's a spread between implied to realized. That's what option sellers try to monetize, is the fact that implied trades above realized. And as more sellers come to the market, you would expect that spread to shrink, which we haven't. And in fact, over the past year, the volatility risk premium has actually doubled. It has richened. The second thing is, given that bulk of these assets are in call overwriting funds, if they've gotten too big, you would expect call skew to become very low or to start to fall, meaning the out of the money call options to become cheaper relative to the at the money. We see the opposite right now. We see out of the money call options actually being bid, and actually historically bid relative to the at the money. And actually, I think the main story right now in the derivatives market is really the upside call buyers, the people hedging their right tail risk rather than the overrider. So all of these things combined with the fact that it's really a cross asset phenomenon, the low volatility kind of really makes me a little skeptical of the claim that these funds are what is driving volatility lower. But certainly the rise in AUM and the popularity in these strategies, I think, is pretty great to see.
Well, you mentioned some of the products built around single stocks, and we've got this really unique configuration in the S&P. It's extremely top heavy, and the top portion of the index has got these names in it that have a considerable amount of vol, at least at different points in time. I mean, NVIDIA, that 16% move, it's got more often than not an inverted call skew, and probably for good reason. And so what I wanted to do is get your read on dispersion and correlation. So far in 2024, the correlation of Apple to NVIDIA is 12%. That's just, I would say, shockingly and probably unsustainably low. But the realized correlation at the index level, super damp or super muted. What do you make of it all? And then maybe we can pivot to some of the work you're doing on dispersion futures.
Yeah, so absolutely. I would say low correlation, high dispersion has been a very distinguishing feature of the market over the past year and a half. So if you want to track dispersion, we launched our DSPX index, which is a measure of S&P 1 month forward looking, so implied dispersion of the stocks within the S&P 500. That launched last year. If you want to track correlation, we have an existing suite of correlation indices depending on tenor. So if example, 1 month implied correlation would be core 1N, 6 months is core 6M, etc. So to give you a sense of how extreme things have gotten, it's not just 1 month. A lot of people focus on 1 month and earnings and, these outsized moves on earnings and tech, obviously NVIDIA, all of that, yes. But if you look at like 6 months, 1 year implied correlation, they're actually all lower today than they were in 2017, right? When the VIX was at 9, that was a record low volatility year. So at least the bull market is kind of pricing the low correlation to be persistent. And I think that's interesting. I think it's interesting. And it's partly a reflection of just the very low realized correlation environment that we've been in for the past year, like the rotations we've seen between sectors, between factors, obviously the dominance of AI and the mega cap tech names. For longer dated implied correlation, part of it I do think is supply demand driven with just a lot less selling pressure on longer dated, single stock vol. But then in dispersion, what we've been highlighting very recently is the fact that, so if you look at the DSPX index, right, there's typically a very strong and very pronounced seasonality. Dispersion or implied dispersion goes up, heading into earnings. Obviously, earnings is a big driver of single stock volatility, and then it comes back in. But what's been interesting recently is that dispersion post earnings didn't really fall and actually picked right back up. At one point, DSPX was higher post earnings than it was before earnings, which is fairly unprecedented. And when we kind of look underneath the index surface to see what was driving it, about half the move came from one stock. It was from NVIDIA. And it was bid to NVIDIA vol in the lead up to their AI conference. So that was post earnings. I thought that was just incredible. It kind of goes to show, as you talked about earlier, the dominance of some of these names on the S&P.
Well, let's talk a little bit about the pronounced hump in the VIX futures curve in and around the US election. What do you make of that?
Yeah, it's interesting. So it's happening earlier than I recall, at least. I haven't done an exact analysis, but I remember in 2016, the conversation was all around why isn't equity vol markets pricing in the election risk when you look at like, say, FX markets and other asset classes that were pricing in the very significant risk premium to the election. And then in 2020, we started really seeing, if I recall correctly, a pronounced VIX term structure premium really in the summer heading into the election. And this year, we started that very pronounced premium, I think a 3-point premium in the October VIX futures as early as, I believe, was in late January when the futures, we started to see that. So it's happening earlier and it's happening at the same time where we're not actually seeing a similar risk premium being priced into the other asset classes. So I thought that was really interesting, the switch where, equity markets used to be the last mover, and now we're really the first mover in terms of pricing in the election risk. I think partly maybe because of the fact that this year, at least, we already know who the general election candidates are going to be this early on in the year. It used to be we had to go through a primary cycle, There was a lot of uncertainty around who's going to be the candidate. But this year, pretty much from the beginning, we all knew, right, it was going to be a rematch. So I thought that was interesting. And the second is if you look at the realized moves in the S&P, if you look at the realized, like how VIX actually performed in elections, around elections, the past two election cycles, we've seen very pronounced VIX jumps. So in 2020, it was double digits. And of course, in 2016, we also saw a very sizable VIX increase in the immediate weeks preceding the election. So I think it's just recency bias that past two elections have been particularly volatile in terms of kind of how the VIX has moved, that we're starting to see this very, very hefty premium already being priced into the market this far in advance of the election.
Well, you stare at that curve and you see the hump, and your first inclination might be, well, I don't want to buy that hump. That's more expensive than everything else. But there's some logic to the idea that that price is just going to hold, that until the event comes and goes, that futures price is going to stick because the market just is bracing itself for, sadly, uncertainty in the good old USA on its own election.
Yeah, I mean, you think about I'm just pulling up the analysis I ran for the previous couple elections, right? So in 2020, the VIX in the month leading up to the election shot up 13 points. In 2016, it was almost 10 points. So a 3-point premium for the election right now, it doesn't seem that high given how the VIX has performed in the last two elections.
Right. Well, I wanted to close out this conversation, which I've really enjoyed. Thank you very much for taking the time and sharing your insights and your work. We talked about this a little bit before we jumped on. You were kind enough to participate in an event I hosted, I want to say it was back in 2021, that featured women in finance in prominent positions. And I just wanted to get your take on the kind of state of progress for initiatives designed to empower careers for females in finance. You're obviously at a large firm and a unique firm in terms of it being the leading exchange in terms of equity derivatives. Tell us about what you see out there in terms of initiatives and progress.
Yeah, sure. I mean, I would say the industry is making progress for sure, but it's undeniable in terms of the focus and the number of initiatives, both when I was at Credit Suisse and also now at Cboe, senior management puts on in terms of helping advance the careers of women. The industry is making progress, but there's still a long, long way to go. That said, here at Cboe, right, my manager is female. The woman who she reports into, who runs global derivatives, Kathy Clay, is female. Our CFO is a woman. So there's definitely, I would say, at Cboe, a lot of senior women at the executive level, as well as the next level down. But to me, in my personal career, things that really helped me the most is mentorship programs and also sponsorship. I think I might have mentioned that on the call that you hosted, but the difference between mentorship and sponsorship being very important in advancing your career. A mentor is someone you go for advice, someone who maybe you can get closer to you in terms of level, but then finding a sponsor, someone who is very senior in the organization, who would actually go out of their way to help you, right? Like that's, I think, critical. And finding a sponsor in your organization who is willing to help you put their reputation at stake for you. This is one of the biggest takeaways for me in terms of my personal career growth, is finding a sponsor to really help advance your career, in addition to obviously the value that comes from having a good mentor. But those two are not the same. I think we're just starting out the career, you think those two are the same, but it's not. There's actually a very big difference between the two.
Well, I appreciate you sharing that. And thank you very much for your time, Mandy. It was great to have this conversation.
Yes, it's been a pleasure. Thank you for having me on.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.